Welcome back to the deep dive. Today we are not just talking about numbers. We're talking about the ability to see the future and, the surprisingly emotional art of letting go.
That is quite the philosophical opening for an episode on accounting standards.
I aim to please. But seriously, today we are tackling a beast. We are looking at IND AS 109, the standard for financial instruments. And before anyone reaches for the skip button, I want to set the scene. I want you to imagine you are driving a car in pitch black darkness.
Okay, I'm driving. It's dark.
In the old days of accounting, and by old days I mean effectively pre-2008 financial crisis, the rules for banking and lending were like driving that car with no headlights. You didn't acknowledge a pothole until your tire was already in it.
Right.
You didn't acknowledge a crash until the airbag was in your face.
You're referring to the incurred loss model.
Right, the incurred loss model. It feels wild to think about now, but companies generally didn't record a loss on a loan until the disaster had basically already happened, right?
That's absolutely right. It was a reactive system. You essentially assumed a loan was perfectly healthy until a specific trigger event occurred, like a missed payment or, a bankruptcy filing.
So even if you knew something was coming.
Even if you knew the borrower was losing their job or their entire industry was collapsing around them, you often couldn't book the loss until the check actually bounced. The rules just didn't allow for it.
It's like waiting until you have full-blown pneumonia to take a vitamin. It's too little, too late. And we saw what happened with that approach, didn't we, during the global financial crisis?
We certainly did.
Banks had billions in what looked like healthy loans on their books that were actually rotting from the inside. But the accounting rules gave them cover to ignore the rot until the whole system collapsed.
Precisely. And that catastrophe was the catalyst for the shift we're discussing today. The regulators, the standard setters, they all realized we needed a new philosophy. We needed to move from incurred loss, which is reactive, to expected credit loss, which is proactive.
Which brings us to our star of the show. In AS 109, this is the radar system. It forces companies to look through the windshield, not just the rearview mirror.
It does. And AS 109 is a massive standard, but today we are zeroing in on two specific, really high-stakes areas. First, that radar system you mentioned, the three-stage impairment model. How do banks predict losses before they happen?
Okay.
And second, a concept that sounds dry but is actually full of legal and financial drama, derecognition.
Derecognition, which is a fancy talk for breaking up.
Essentially, yes.
Yeah.
And that asks the question, when is an asset truly gone? When have you actually sold a loan versus just pretending to sell it while secretly, holding on to all the risk?
We have a massive stack of sources today. The standard itself, implementation guidance, basis for conclusions, and our mission is to decode this. We are going to walk through the traffic light system of impairment, and then we're going to navigate the decision tree of derecognition.
And we should warn everyone listening, this gets complicated. We're going to talk about cliff effects, probability weighting, and why selling 90% of something might mean you still own 100% of the risk.
I love it when the math defies common sense. Let's dive in.
Let's do it.
So let's start with the radar, the expected credit loss, or ECL. The old way was wait for the crash. The new way is predict the crash. But predictions are hard. I mean, economists have predicted 9 of the last 5 recessions, right? How can an accountant do it?
It's definitely not an exact science. But IND AS 109 requires entities to try. It moves away from that binary good loan, bad loan switch and introduces a spectrum. We call this the three-stage model.
I like to visualize this as a traffic light. You have green, yellow, and red. Every loan you make, every bond you buy, it sits somewhere on this spectrum.
That's a very helpful analogy. Let's start with the green light. This is stage 1.
Okay, stage 1. I lend you money today. You have a great job, a nice house, and a credit score that makes me jealous. This is a good loan. A green light.
It is. This is initial recognition.
Mm-hmm.
Credit risk is low, but, and this is the huge shift from the old rules, even here, on day 1, I have to book a loss.
This is what confuses people. I lend you $100. I expect you to pay me back $100 plus interest. Why on earth am I telling my shareholders I've already lost money?
Because in economics, there is no such thing as zero risk. There is always a tiny non-zero probability that, I might walk out of this studio, get hit by a bus, and never pay you back. Under IND AS 109, you have to quantify that risk immediately.
Okay, so I have to book a provision. The sources call this the 12-month ECL. Now help me out here, because 12-month ECL sounds like losses I expect to happen in the next 12 months.
It sounds like that, but that is a dangerous oversimplification. If you just book the losses you expect to happen, For a good borrower, the number would likely be zero. You don't expect a default.
Right, I expect you to pay. There's a whole point of lending money.
So the 12-month ECL is actually a probability-weighted calculation. You're asking, what is the probability of a default occurring within the next 12 months? Let's say it's very low, maybe 0.5%.
Okay.
Then you ask, if that default happens, how much money do I lose? That's the loss given default. Let's say you'd lose $50 after selling collateral.
So I take 4.5% of $50. Is it that simple?
That's the core of it, yes. You are booking the portion of the lifetime losses that are associated with default events that are possible in the next year. It's usually a small number,
Yeah.
but it acknowledges that the risk exists from the moment the ink is dry.
It's like paying an insurance premium. You don't expect your house to burn down this year, but you pay a little bit just in case.
That's a fair way to look at it. And a crucial point,
Yeah.
in stage 1, while we book this small loss allowance, we calculate interest on the gross carrying amount.
Meaning the full $100 I lent you?
Correct. You get the full benefit of the interest income on the face value of the loan. Everything is effectively normal. The system is green.
Until it isn't.
Until it isn't.
Now we move to stage 2, the yellow light. This is where things get sweaty for the bank manager. The standard calls this a significant increase in credit risk, or SICR.
This is the most volatile and, frankly, the most judgmental part of the standard. This is the transition zone. The borrower hasn't defaulted yet. They might still be paying on time. But something has changed fundamentally since day 1.
Give me a real-world detective story here. How does a bank know I'm in the yellow zone? I'm still making my payments. What are they looking for?
They look at what the standard calls reasonable and supportable information. It's a mix of hard data and soft signals. For one, they look at market indicators. If you're a corporate borrower, they look at your bond yields. If your bonds are suddenly trading at a huge discount, the market is screaming risk.
So even if I'm telling the bank I'm fine, the market knows. The collective wisdom of the crowd.
The market usually knows first. They also look at credit default swaps, CDS. If the cost to insure against your default doubles or triples, that's a massive red flag. That could be a stage 2 trigger.
What about for a regular person then? You're not checking the bond market for my mortgage.
For retail borrowers, it gets more personal. They look at behavioral scoring. Banks have these incredibly sophisticated algorithms that watch you like a hawk. Did you suddenly max out your credit card this month?
Oh, wow.
Did you start using your overdraft facility every single month? Are you paying your mortgage 10 days late when for the last 5 years you used to pay 5 days early? All these little changes in behavior are data points.
It's like the bank is stalking me. He's buying groceries on credit. He must be in trouble.
In a way, yes. And of course, there is the backstop. The standard says that if payments are more than 30 days past due, there's a rebuttable presumption that credit risk has increased significantly.
Rebuttable presumption. I love that legalistic language. So the 30-day mark is the line in the sand, unless you have a really good excuse.
It's a strong indicator. You can rebut it if you have proof it was just an administrative error, but usually 30 days late means you are now in stage 2.
Okay, so I'm in stage 2. I'm risky. Why does the bank care? I mean, really care. Is it just a label in their system?
Oh, it is much, much more than a label. This is the cliff effect I mentioned earlier. When an asset moves from stage 1 to stage 2, the accounting rule changes drastically. You stop providing for 12-month ECL, and you must now provide for lifetime ECL.
Whoa. Slow down. Let's play that out. I have a 30-year mortgage. I'm in year 1. I've been a good borrower, but I lose some freelance work, and I miss a payment by 35 days. I slide into stage 2. What happens in the bank's books?
In stage 1, the bank was holding a reserve of maybe, say, $50 against your loan, a tiny amount. Suddenly, in stage 2, they have to look at the entire remaining 29 years of that loan.
The whole life.
The whole life. They have to calculate the probability of default over that whole lifespan, factoring in potential recessions, unemployment, everything.
That number has to be massive compared to the 12-month number.
It can be 10 times, 20 times higher, sometimes more. Imagine a bank with a billion-dollar loan portfolio. If the economy turns and a chunk of those loans slide from stage 1 to stage 2, their profits for the quarter can effectively vanish.
Just like that.
Just like that. They have to move millions of dollars from profit to loss reserve overnight. It's a huge, immediate hit to the P&L.
That explains why banks are so terrified of recessions. It's not just the actual defaults. It's the expectation of future defaults that triggers this massive stage 2 accounting hit.
Exactly. It makes the financial statements much more volatile. But proponents of the standard would argue it's also much more honest. If the risk has gone up for the long term, shouldn't the balance sheet reflect that reality today?
I suppose. It's painful honesty. Now, one more thing on stage two. Am I still charging interest on the full amount of the loan?
Yes, that's a key point. Interest is still on the gross carrying amount. The loan isn't dead yet. We are just very, very worried about it.
Yeah. Green, yellow, now
Hmm.
red, stage three. The car has crashed.
Stage 3 is credit impaired. The default has, for all intents and purposes, happened.
What defines the crash? What makes a loan officially credit impaired?
It's usually when a default is considered probable. Bankruptcy is filed, the borrower has lost their primary source of income, and there's no prospect of replacement. Or, more commonly, they are 90 days past due. That's the usual backstop for stage 3.
So now we are definitely booking lifetime ECL, just like in stage two. The provision amount is probably even higher now.
Yes, the provision is the same concept. Lifetime, though the probability of default is now effectively 100%, so the number is even bigger. But the big change in stage 3, the real critical twist, is how we recognize income.
This is the net interest concept.
Right. In stage 1 and stage 2, you charge interest on the gross amount, the full $100. In stage 3, the standard says, stop kidding yourself. You have to calculate interest on the net carrying amount.
So if I lent you $100 and I've now booked a loss allowance of $60 because things look terrible, my net amount is $40
And you only recognize interest income on that $40.
because the other $60 is gone. It's a ghost.
You're assuming it's gone. Yes. It prevents companies from inflating their revenue numbers by accruing interest on phantom money that they are never, ever going to collect.
That seems like a crucial anti-fraud measure. I remember stories from the old days where banks would keep accruing interest on these zombie loans just to keep their earnings looking good on paper.
And AS 109 kills the zombie loans. It forces you to bury them.
So that's the main model, stage 1, 2, and 3. But I saw some exceptions in the notes, something about trade receivables. I assume a company selling widgets doesn't have a team of actuaries calculating probability-weighted default curves for every single invoice.
Thankfully, no. Can you imagine the complexity? For trade receivables, short-term invoices owed by customers, there is a simplified approach.
How does that work? Is it simpler?
Much simpler. You skip the stages. You don't worry about significant increases in credit risk. You just assume everything is lifetime ECL from day one.
That sounds harsh. Lifetime loss immediately on every sale.
It sounds harsh, but remember, the life of an invoice is maybe 60 or 90 days. So the lifetime ECL is just the expected loss over those 60 days. It's actually much easier to calculate. A company just uses what's called a provision matrix.
A matrix, like a spreadsheet.
Exactly. They look at their history. Historically, 1% of invoices that are 30 days overdue don't get paid. 5% of invoices that are 60 days overdue don't get paid. 20% of those over 90 days are a write-off. They just apply those historical percentages to their current receivables. Done.
Okay, that saves the sanity of the corporate accountants. Now, there was one other acronym that caught my eye. POCI. Sounds like a delicious Italian dish. I'll have the POCI with marinara.
It's definitely not delicious. It stands for purchased or originated credit impaired.
This is the vulture fund scenario, right? Buying up bad debt.
It is. Imagine a bank is collapsing. It has a portfolio of bad loans, face value $100 million. But everyone knows the borrowers are broke. A distressed debt fund comes in and buys that entire portfolio for, say, $20 million.
Okay, so I'm the fund. I paid $20 million. I know these loans are garbage. That's why I got them so cheap.
Exactly. Now, under normal rules, these loans are stage 3 immediately. They are already defaulted. But if you booked a stage 3 loss on day 1, you'd be double counting. The price you paid already reflects the expected loss.
Right. If I paid $20 million, I don't want to immediately write it down to zero. $20 million is what I think it's actually worth.
So for POCI assets, you never have a stage 1 or stage 2. You start in a special category of your own. And here is the fascinating part. You calculate a credit-adjusted effective interest rate.
That sounds incredibly technical. Translate for me.
Normally, interest is based on the contract rate, say 5%. But for POCI, you calculate an implied interest rate based on the cash you actually expect to get. If you bought the portfolio for $20 million and you think you can squeeze $25 million out of these borrowers over the next 5 years...
That $5 million difference is my income.
Right. And you accrete that as interest income over the life of the asset. The magic here is that if you manage to turn the loan around, if you get the borrower to pay more than you expected, that's all upside. You can actually see a reversal of the impairment.
So POCI is a unique beast because it's the one place where bad news is the baseline and any good news is a gain.
It's the accounting of redemption.
A perfect way to put it. Okay, that covers the radar system. We know how to spot the crash coming with stage 2, and we know how to deal with the wreckage in stage 3. Now, I want to pivot. We're moving from, is this asset damaged, to, is this asset even mine? This is part 2, derecognition.
The art of the breakup.
You know, in the physical world, selling something is easy. If I sell you my car, I give you the keys, you give me the cash, I walk away. I don't worry about whether the engine explodes next week. It's your car, your problem.
Right. Simple transaction.
But in finance, nothing is ever that simple. I can sell you a loan, take your cash, sign a contract that says sale, and yet the accounting standards might say, nope, you still own it.
This is the core concept of substance over form. The legal contract, the form, might say sale. But the accounting standard looks at the economic reality. Who bears the pain if things go wrong? Who gets the glory if things go right?
The sources outline a decision tree for this. It feels like a flowchart for a relationship counseling session. Step 1 is the easiest. Expiry.
That's the clean break. Has the contract expired? Did the borrower pay off the loan in full? If yes, derecognize. You remove it from the balance sheet. End of story.
Okay, but usually it's not that simple. Step 2, transfer. Did I actually give the asset to someone else? This seems obvious, but the sources mention something called pass-through arrangements. This sounds like a loophole waiting to happen.
It's extremely common in the world of securitization, like with mortgage-backed securities. Think about it. You take out a mortgage with Big Bank, but Big Bank wants to package your mortgage with thousands of others and sell it to a pension fund.
Okay, so the pension fund owns my mortgage now.
Technically, yes.
Yeah.
But do you mail your monthly check to the pension fund? No. You still mail it to Big Bank. Big Bank collects your cash and then passes it through to the ultimate investors.
So Big Bank is just a middleman, a pipeline.
Exactly. But to treat this as a sale and get it off their balance sheet, Big Bank has to prove they are just a pipeline. They can't be a reservoir.
What's the difference? That's a great analogy.
There are very strict conditions. First, Big Bank must have no obligation to pay the pension fund unless they collect from you. If you default, and Big Bank has to pay the pension fund out of its own pocket anyway, then Big Bank isn't a pipeline.
They're an insurer at that point.
Exactly. They still own the credit risk. The asset stays on their books.
Makes sense. What else?
Second, the no material delay rule. This is where banks used to play games. They would collect your mortgage check on the 1st of the month, but not pay the pension fund until the 28th.
And in those 28 days, they invest my money and make a quick, risk-free profit.
Precisely. That's arbitrage. NDS 109 says, if you do that, you haven't derecognized the asset. If you are using the cash flows for your own benefit, you still effectively control the asset. You can't have your cake and eat it too.
Wow. So to be a true pass-through, you have to be completely hands-off. You can touch the money, but you can't hold it or use it.
You're just a conduit.
Yeah.
A very boring, uninvesting conduit.
Okay, let's assume we pass that hurdle. We have a genuine transfer. Now comes the heavyweight champion of tests, the risks and rewards test.
This is the primary test. This is the heart of it. The question is, did the entity transfer substantially? All the risks and rewards of ownership?
Let's role play this. We are at a deal table. I have a portfolio of loans worth $100 million. I want to sell them to you. Scenario A. I sell them to you for cash. You take the loans. If the borrowers default, you cry. If interest rates go down and the loans become more valuable, you cheer. I walk away and never think about them again.
In that case, you have transferred substantially all risks. That's the default risk. And all rewards, which is the interest and capital appreciation. Result, derecognition. You wipe the loans off your books. It's a clean break.
A clean break. Now, scenario B. I sell them to you, but you're nervous. You say, I don't trust these borrowers. This portfolio looks a bit shaky. So I say, tell you what, expert, if any of them default, I promise to buy the loan back from you at full price.
Ugh. The classic recourse clause, a full guarantee. In this case, I have the legal title to the loans. But who has the credit risk? Who feels the pain if a borrower defaults?
I do, because if they go bad, they come right back to me like a boomerang.
Exactly. You have retained substantially all the risks. So NKS 109 says, no derecognition. You keep the $100 million of loans on your balance sheet, and the cash I gave you, you record that as a liability, a secured borrowing.
So even though the contract says sale of assets, the balance sheet says borrowed money.
Substance over form. The economic reality is you just took out a loan and pledged your assets as collateral.
Now, what happens if we are in the messy middle, the gray area? I don't give you all the risk, but I don't keep all of it either. The standard calls this neither transferred nor retained substantially all risks and rewards.
This happens a lot with complex derivatives or partial guarantees. For example, you sell the loans, but you only guarantee the first 10% of losses. Or you keep some of the upside if interest rates really spike.
So we're in the gray zone. Risks and rewards didn't give us a clear yes or no answer.
That's right. So we need a tiebreaker.
The tiebreaker is control.
The tiebreaker is control.
Control. That sounds simple, but I bet it's not. How do we test for control? Is it about legal ownership?
Not necessarily. I like the balloon on a string analogy.
Yeah.
Imagine I sell you a balloon. That's the asset.
Okay, I'm holding the balloon. It's mine.
The test is, can you unilaterally sell that balloon to a stranger? Can you walk away and trade it for a lollipop without my permission?
If I can, then I have control. It's truly my balloon.
Right. And if you have control, I must have lost control. So I derecognize the asset.
But what if I can't sell it? What if the contract I signed with you says you can't sell this balloon without my permission? Or what if it's a really weird, unique balloon and the market for it is so obscure that nobody else would ever buy it from me?
Then I still have a string tied to that balloon. You don't have the practical ability to transfer it to a third party. So I have retained control. You don't really own it, you're just holding it for me.
And if the seller retains control, the asset stays on their books.
Yes. But here's the nuance, and it's a big one. It stays on the books only to the extent of their continuing involvement.
Continuing involvement, that sounds like a relationship status. It's complicated.
It is complicated.
Yeah.
Instead of keeping the whole asset on my books, I might just have to record the value of the string I'm holding onto. So if I provided a guarantee, I might not keep the whole $100 million loan on my balance sheet, but I'll record a liability for the maximum amount I could lose on that guarantee.
So it creates a weird hybrid on the balance sheet where I recognize just the slice of the asset that I'm still tethered to.
Exactly. It's an attempt to reflect that messy middle ground where ownership is shared.
This is getting deep. I want to hit on one of the most complex areas that the sources mentioned because I feel like this is where the financial engineers really get to work and try to outsmart the standard. Partial derecognition. Can I chop up an asset? Can I sell the left half of a loan and keep the right half?
You can, but the rules are incredibly strict to prevent cherry-picking the good parts and leaving the bad parts on your books.
The sources gave two examples. One worked, one didn't. Let's look at the one that worked first. The 90-10 split.
This usually works when you're selling specifically identified cash flows. For example, an interest-only strip. I have a government bond. It pays a principal amount at the end and interest coupons every 6 months. I can sell you the right to all the future interest payments, but I keep the right to the principal.
Can I derecognize the interest part, the part I sold?
Yes, because the cash flows are specifically identified and distinct. They're separate components. Or if I simply sell you a straight 90% share of everything, a pro rata share, you get 90 cents of every dollar that comes in, whether it's principal or interest, that works too. You can derecognize 90% of the asset.
Okay, clean and simple. Now let's look at the one that failed. This was the disproportionate guarantee. This is fascinating. Let's say I have that same $100 million portfolio. I sell you 90% of the cash flows. You get 90% of everything by UD. I provide a guarantee for credit losses up to 8% of the principal amount.
This is a classic first loss structure. Think about what's happening here. You sold 90%, but you guaranteed the first 8% of any losses that occur.
8% sounds small. 100 million, 8 million, I'm only guaranteeing a tiny bit.
Is it small? Think about a diversified portfolio of mortgages. Even in a bad recession, what's the total loss rate? Maybe 2%, 4%. It is incredibly rare for a whole portfolio to lose more than 5 or 6% of its value.
I see where you're going. The losses always happen at the bottom first. The first few defaults are the most likely ones.
Exactly. By guaranteeing the first 8% of losses, you have effectively kept the risk for almost every likely default scenario. You might have transferred the upside, the interest on the healthy loans, but you kept almost all of the probable downside.
So even though I legally sold 90% of the cash flows, the accounting standard looks at the economic substance and says, nice try, you're still holding the bag.
Correct. The standard says you have retained substantially all the risks of ownership. You cannot derecognize. The whole $100 million stays on your books, and the $90 million you receive from me is treated as a loan.
That is brilliant. It stops companies from slicing off the safe part of an asset, selling it, and claiming they've deleveraged, while actually sitting on a ticking time bomb of the risky part.
It forces the balance sheet to tell the truth about where the real danger lies.
So, we've been through the looking glass here. We've seen how impairment forces us to predict the future with ECL, and how derecognition forces us to admit what we truly own, what we're really on the hook for. If we zoom out, what is the big takeaway for our listener? Why does this matter to the person who isn't a CFO or an accountant?
It matters because these rules act as a truth serum for the entire economy. When you look at a bank's stock price or you look at the stability of the financial system, you are relying on the numbers in their financial statements being, well, true.
Right.
If we didn't have the ECL model, especially the stage 2 cliff effect, banks could hide rotting loan books until the day they collapsed. That puts your deposits, your pension, your entire economy at risk.
And if we didn't have these derecognition rules?
Then companies could act like Enron did. They could create these off-balance sheet vehicles, stuff them full of debt, and pretend they were financially healthy while actually being leveraged to the hilt. NX 109 shines a very bright light in those dark corners.
So it's about transparency. It's about making sure the map that a company publishes actually matches the territory they're operating in.
That's the perfect way to phrase it.
I have one final thought to leave everyone with. We've spent this whole time talking about risks, rewards, and control. These are very traditional, almost physical concepts. But the world of finance is changing at a dizzying pace. We have crypto now. We have DeFi, decentralized finance.
A whole new world.
If I put my crypto into a liquidity pool, do I control it? I have a smart contract, but I can't stop the code from executing. I don't control it in the traditional sense. Who has the risk? The rewards. It's all distributed.
That is the billion-dollar or maybe trillion-dollar question that standard setters are grappling with right now.
The very concept of ownership is becoming fluid. AS 109 is a fantastic tool for the world of banks and loans and bonds, but I wonder, in 10 years, will control mean the same thing? Or will we need a whole new decision tree, a whole new standard for the digital age?
Accounting always chases innovation. We are just catching up to the 2008 crisis with this standard. I'm sure the first major crypto crisis will spawn IND-AS 209 in due time.
That's a sobering thought. IND-AS 209. You heard it here first. So next time you look at a bank's quarterly report, don't just skim the profit number. Look for that impairment line. Look at the notes on derecognition and ask yourself, how much of this is stage 1 versus stage 2? Because that, my friends, tells you the real story of their future.
Couldn't have said it better myself.
Thanks for diving deep with us. We'll see you on the next one.